Well, it's hi, folks. We've been giving a lot of investment advice, and for those of you who are not following us, if you subscribe to stuff on our website, there's lots of views going out. And in our previous webinars, we've gone through investment opportunities. But what's been very interesting over the course of the last little while is a lot of companies in South Africa coming out with their perspectives, coming out with the results and the experiences that they're having in the crisis that's happening at the moment. So my intention is to take you through kind of a trip around South Africa, around corporate South Africa, breaking corporates into suppliers, retailers, landlords, and customers, and giving you a perspective of what's happening out there and some initial feeling for where we could be heading. I think one key theme that's coming through is complete uncertainty, and companies are really, in fact, the retailers, who are very good at giving you year-on-year numbers. The numbers that they've come through with, they've been very shy to tell you exactly what's happened since the 1st of April. So I think, in summary, what we're saying, our overriding perspective, and that's how we run our business from an investment point of view, is to buy great businesses at good prices. And really, that's the filter that we apply. When we look at the market, we don't want to suddenly buy bad businesses because they're very cheap. But there certainly have been and will continue to be some great opportunities to buy some great businesses that perhaps previously were a little bit expensive and to get them now at good prices. Based on the initial indications that we've seen, if you strip Naspers out of the South African market, it's about 25% of the market, so it can distort numbers. We think South African company profits will be down more than 50% in 2020. And going into this, I think most people felt that we could return to 2019 levels in 2021, but increasingly that might even be a year out. What's been quite surprising is how companies have held on to cash. Even kind of your dividend bellwethers like Pick n Pay and Clicks decided not to pay a dividend. Richemont, which is very aware of people relying, a lot of older retired people who've been in Richemont forever, relying on their dividend. And despite the fact that Richemont have got 50 billion rand in cash, they've always been very conservative. They halved their dividend. So it's very difficult to get returns or dividends or yields out of shares and increasingly out of the property market. And from an asset class point of view, in the asset management industry, the bond market is actually landing up being the only place that one can get some yield. The predictions out there from listed company CEOs is that it'll take 12 to 36 months to reach normality. And we are seeing very different experiences across different sectors. A theme that's come through in the last 10 presentations I've watched is that clients are now looking for more variable cost bases. So you're going to see that in the property market, where people will want to see their rentals more tied to their turnovers. But I think what people have learned is when turnover goes to naught, a fixed cost base can be absolutely toxic. And then another key theme coming through is that the underlying consumer trends that have been there for the last few years are accelerating. And the two that we see coming through is the search for price and value and embracing e-commerce. So people who sell branded, higher-priced consumer products will be under some pressure. People, especially on e-commerce, are prepared to go for price, and certainly a massive shift in people's willingness to shop online. And then lastly, the crisis will pass like others, but the world will change and we'll come out of it having to service more debt. And I think that's a theme that Michael was talking about. Just to remind you that the world market has bounced back quite sharply. In fact, the MSCI World, which is an indicator of the world stock market, is now down only 15% for the year, but it's back to the levels of where it was in November last year. So over a 6-month period, you're actually flat. But indexes can be a little bit deceiving. There's a massive amount of tech companies that have continued to do very well. On the S&P in America, 5 companies comprise 21% of the index, and most of their share prices are up. So underneath that, there's a lot of opportunities, and we spent a lot of time communicating to our clients the investment opportunities that exist in this scenario. Again, echoing what Michael had to say, job profiles have changed. Certainly this year, it's probably the worst year in 20 years for a young honors graduate to be looking for a job. And that's not just here, but overseas. Massive retrenchments all over the world. There's currently no job for a matric. There's no job for a retrenched 50-year-old. And 35 million Americans are unemployed. That's from 6 million, if you look back a few months ago. Hopefully, not all of those are permanently unemployed. A lot of companies have done what they call furloughed employee. So for a time period, they're taken off the payroll. So this will change, but that's the reality for now. The most compelling quotes that I've seen coming through from companies, and in fact, this has been a somewhat emotional period. Brian Joffe, who's probably one of South Africa's most respected and with the best track record, started and ran Bidvest. He now runs a smaller company called Long for Life, which owns Sportsman's Warehouse, Outdoor Warehouse, and Sorbet, among others. And this quote kind of resonated, where he said, prepare for the worst and hope for the best. So make the tough calls now, and if things turn out a bit better, you can always re-employ people or start CapEx programs again. Johan Rupert from Richemont in the recent results indicated a strong balance sheet puts you in charge of your own destiny. He was saying how investment bankers through the years have always told him to gear up and use his balance sheet more effectively, but they went into this crisis with 50 billion rand of debt. So you can be assured that they'll survive. And then something that a lot of CEOs are faced with, where they perhaps don't want to go back to work, but the CEO of the world's #1 pork producer, Smithfield, saying, during this pandemic, our entire industry is faced with an impossible choice: continue to operate or to sustain our nation's food supply, or shutter in an attempt to entirely insulate our employees from risk. And then another indicator from Brian Joffe, who actually got quite tearful in the presentation when referring to people like the Sorbet franchisees. These are great entrepreneurs who've risked everything to start their businesses. And I think back to Grant Patterson in a WhatsApp message that went around, getting quite tearful, talking about the prospects for Edcon. So indicating the gravity of the situation, I've experienced many challenging events during my 50-year working career, but nothing comes close to the experiences of the first few months of 2020 following the outbreak of the COVID-19 pandemic. This extraordinary time will shape a new future. It will forever be known as the period in which we changed paradigms, changed ways of working, and changed the way we relate and interact with each other. And then the last quote from Shamil Jusuf from VODACOM, indicating that data traffic had increased 110% year on year. Their base is obviously a lot bigger than Rain, but earlier on, Michael Jordaan indicating that Rain's data consumption had gone up as much as 4 times. So where are we now in the world? To summarize, in South Africa, we've seen economists come through with GDP predictions of down between 6 and 18%, and then bouncing back in 2021 by 5 to 7%. So still not taking us back to 2019 numbers by the end of 2021. Companies have come out with March results, but these are largely irrelevant. And we've never heard companies talk so much about their prospects. Business rescue or liquidation, we've seen SAA, Comair, Edcon, Phumelela, number of magazines closing down. And it's really a focus on cash. And a key theme coming through is that companies are managing their business for cash and not worrying about accounting profits. So if you look at the life of retailers, they've obviously missed a 6 to 8 week period to sell the last bits of their summer clothes. And now basically you're going to see massive write-downs. And they really have to bring that cash in and not worry about the cuts that they're taking. So a focus on cash flow and survival, the dividends being stopped, some really, really big SA companies not paying dividends, but there are some offsets. For somebody who's got a job and earning the same salary, effectively their cost base is significantly lower. Prime could go down again today. That's our expectation. So money becomes 35% cheaper. Fuel is 30% cheaper. And we could, in fact, for a short time period, have deflation. And I'm referring there specifically to retail stores who have to get rid of product to realize cash to go forward. House prices in South Africa could be flat for an astounding 10 years. So they certainly have been for the last 5 years and probably will be for the next 5 years. So that poses the question, who would build a new house? It would follow that property rates should come down, but at the same time, that's probably just wishful thinking. This slide shows VODACOM indicating their data traffic growth over the years and some significant price elasticity. So if product is cheaper, people buy a lot more of it. Then a key point to make is a lot of businesses out there, certainly in the analyst community and when people are looking at businesses, that they're not brave enough to realize how devastating this is on companies. We've done a very simple example here of a business with a 16% operating margin, And effectively, they start making a loss if their turnover goes down 50%. And in fact, businesses with a much smaller operating margin, kind of the food retailers sitting at 4, 5, 6%, they only need a 20% drop in turnover to start making a loss. So where we find ourselves in the business cycle, there's businesses that have got zero or much lower turnover for a time period. And during those months and those time periods, a lot of these businesses are in fact incurring losses. So if you look at companies over a 12-month period, a lot of it depends on how many months they've got that kind of equation coming through. This is why we're predicting that SA corporate profits ex NASPAS will be down as much as 50% for the year. So we really have put companies into 4 categories. The safe ones, where they're positively or at best neutrally impacted by what's happening out there. So that's your NASPAS, British American Tobacco, Aspen, Asset Management, VODACOM. Then the second line is probably where the opportunities lie, because share prices might well have overreacted. So companies will have temporarily lower profits or small losses. So we talked about a few months of the equation that I talked about in the previous slide, but they'll emerge in good shape because their balance sheets are strong enough. And really, we started off this presentation saying at the moment we're balance sheet detectives. That's the first thing that we look at in a business. When I started off as an analyst, we'd simply look at an income statement and year-on-year growth. The world has increasingly changed, where the shape of the balance sheet and your ability to see through tough times becomes increasingly important. Then companies that we're more wary of, but from a share price point of view, it kind of depends what's priced in. So where they'll have lower profits or losses for the year, and these leave the company with a balance sheet weakened. So in other words, if a company loses a lot of money, they have to borrow more and enter into the new world with a much higher level of debt. And then companies who might not survive or at best need a rights issue. And we're obviously pretty wary there. So the Comares, the Sun Internationals, Invicta, Sapaku, and Sasol, although the oil price is giving some protection now. A slide that absolutely amazed me was the fact that Zoom, which is the technology that we're using right now, has now got a value more than the top 7 airlines in the world. Now, Zoom in December 2019 had 10 million users a day. If you move out 4 months, they're now sitting at 300 million users today. There's over 1,000 participants on this call, which is something we would never even have imagined if you go back a few months ago. And it's some interesting anecdotes from companies around town. It was quite amusing listening to Richard Brasher, the Pick n Pay CEO, explain rich saints and housewives going into the shop, and whereas they used to buy salmon and Norwegian salmon, they were now buying bully beef and tinned meatballs. And the tins got cleaned off the shelves. There's some sort of psychological aspect to people that they think if they're going to be in lockdown for a time period, they need to buy stuff in tins. Then from a client point of view, various different experiences. I think people are going for lower priced goods. So I think chicken, pilchards and the like is being boosted. And we've got a client who's a cattle farmer who, he said he used to view his cattle as cash, but couldn't sell them. But he's sitting in a segment of the market, which is the lower end of the market. Another client who owns a spa saw butchery sales up 80%. And a client high-end seafood retailer has seen sales up 300%. And you can kind of understand that people can't dine out, so they're spending more on cooking nice meals at home. Interestingly, from a property point of view, Twitter announced that their staff can now work from home across the board indefinitely. So there's a lot of questions about the demand for office space going forward. What's coming through is that price and value is key. And as we said earlier, that's a challenge to branded consumer goods companies. So a company like Tiger Brands going into this was facing a lot of pricing pressure, customers questioning whether they needed branded products, and that's only going to become more difficult. And a company's internet presence is becoming a key survival factor. So let's look through the suppliers. So I've taken a number of the more interesting numbers that have come through. The slide on the right-hand side shows the Sun International share price, which has gone down from a high of over 150 Rand to 15 Rand. So down 90% off its highs. They're obviously generating close to zero turnover at the moment. They've got a 2 billion Rand market cap and 13 billion Rand of debt. So there's almost certainly a rights issue coming there. To indicate value, they're sitting on a 2.5 times historic PE, but that really is history. Booking.com, which many would have used, April, interestingly, their revenues were down more than 100%. That sounds impossible, but obviously they took forward bookings, which have subsequently been cancelled. VODACOM, we talked about. The hospital space is an interesting one. Life Healthcare indicates that occupancies are 40% at the moment. They decided not to pay a March dividend. Netcare have suspended all non-essential elective surgery. And to give you an indicator of the complexities of the hospital game, is they've cleared out their hospitals waiting for COVID. But in Gauteng, there's only 58 COVID patients in the whole of Gauteng in hospitals. And there's 107 hospitals, which means half a person per hospital. So going back to that slide we talked about earlier, these hospital companies are making massive losses on a monthly basis at the moment. And their future really depends on how long it takes to fill up those beds. And we're concerned for them that the COVID patients, especially if they've come from government, government's obviously going to be negotiating pretty good prices. Distel, alcohol producer, saying profits to June down 65%. Spark ATM saying cash withdrawals down 50% in April and down 40% in May. Some South African mines are operating at 50% capacity, which almost certainly means that they're making losses. And then for the mines, they obviously want to work and they're making a lot of noise about coming back to work. But when COVID hits, there's nothing they can do. So 2 days ago, Impala announced in their Marula mine 19 COVID cases. That's 6% of their production. So they in fact suspended production there. Richemont indicating that a lot of their survival is based and turnover is based on travel-driven initiatives. So people, when they're on holiday, tend to buy luxury goods. So some concern there. And Johan Rupert was projecting a 12 to 36 month before normality. Interestingly, from a travel perspective, if you picture what happened after 9/11, what happened from an airport perspective, you can just imagine what's going to happen when you go to an airport in a month or 2 or 3's time. And the CEO of Dubai Airports was saying that traveling on an aeroplane or an international flight will be more painful than open heart surgery. And, just picturing that some planes have got 400 people on. If in a queue, everybody has to be 2 meters apart, that implies a queue almost 1 kilometer to get onto one plane. So it's going to be interesting to see how they work it all out. Then debt-laden companies are really in the hands of banks. We chatted to a particular property company yesterday, which gives a good example, where they've negotiated with their bank for a 6-month period that they'll simply pass on the rentals that they receive. If that net amount is lower than interest, then interest will roll up and all capital payments will be stretched out. And this is really why we will survive this equation. We've got strong banks, and for good businesses, and particularly those with very competent management, they're able to negotiate situations with the banks where they can see through. And then, of course, most of you will know about the guarantee fund, where government has effectively put a 200 billion rand guarantee behind banks helping businesses through this time period. So that's your suppliers. A slide that we extracted from ALTRON. This is a typical South African example. So they've in fact gone back and reversed their 2020 salary increases, freezed any new salary increases, freezed headcount, halving the bonuses of management, reducing non-executives, the directors' fees. And this is what we're seeing kind of across corporate South Africa. Some interesting pictures from Astral. So when you're sitting in your dining room eating your chicken, this is what's happening on the other end. So you can see right across the business, even in the boardroom, people being prevented from being in proximity with each other. A slide from Richemont. And what I find most astounding is the growth in online retail. So you can see in the time period here at 14% against other areas going down 2 or 3%. Now remember, this only includes probably 1 month of COVID. So this will become dramatically different in the new year. But who would have thought that luxury goods, your luxury watch, your Mont Blanc pen, people would be buying online if you think back a few years ago. They're now sitting at 19% online. So we're really starting to realize that anything can be sold online. So what about the property companies? This is a very busy slide, but I've put it here because a lot of people want to see the detail. For those of you who want this presentation, give us a shout and we can send it to you. So Growth Point, which is kind of the bellwether South African property company, if you look at the bottom right-hand corner, indicating their collections for the months of April and May. So they collected 71% of rent in April and 70% of rent in May. Now, to give you a feel for what that means, for the higher quality malls, which have been much more expensive to build and have got a lot more cost, they need about a 65 to 70% rent collection to cover their interest cost. For lower quality, cheaper malls, they probably need about a 55% collection. So the companies are going through periods now, effectively, of covering a little bit more than interest. If they've got the balance sheets to see through, they'll be fine. But as you'll understand, they need some cooperation with the banks. What's also kind of being questioned, a lease was always a long-term document. Is that a piece of paper now? A lot of tenants, we think, are trying to take advantage of the situation where they are trading and making reasonable numbers. But probably the most interesting fact that I've seen is a lot of you would have heard of WeWork, which is kind of the temporary office accommodation and considered to be quite a funky business. They were going to list a few months ago, probably about a year ago, at $49 billion, and their owner, SoftBank, has now revalued them at $2.9 billion. So that's how much the world can change. So this entire sector will reset. I think you can pretty much forget dividends from most companies in the property sector this year and next, as they need to retain that cash to shore up their balance sheets. And there's a period of renegotiation. We saw in the national tenants came out and offered property companies 20% of rent in April and May. The property companies came back collectively and said 50% for the month of April. But that's really all now fallen apart. And the big property companies are negotiating directly with the national tenants, and I think reaching more reasonable conclusions. I think some of the tenants, some of the landlords, rightfully so, are saying that in May, if people are trading, they must pay 100% of their rent. But we'll only really know in 6 months' time how many months of this we went through. As an indication of what might come, Namibia is a few weeks ahead of us. On the 4th of May, their malls reopened. The information that we've got is they're actually trading well, surprisingly well. But there may be a little bit of pent-up demand and what we call the coiled spring coming through there. Sit-down restaurants are not allowed in Namibia, and that's what we'll see here. South Africans are heavily invested in Poland. There they've listed restrictions on centers larger than 2,000 square meters. All the malls have resumed normal trading, and by all accounts going pretty well. And restaurants, again, closed and only allowed to provide takeaway. Then let's move through to the retailers. So you'll see on the slide on the picture on the right, Spur Steak Ranches, a taste for life in 155 out of 559 restaurants. For people with a big footprint, and it goes back to that profit on turnover level, if you've got a big rental cost, takeaway just simply isn't enough to make a profit. So a lot of the Spur stuff, the Rokomamas, where takeaway can work, they've opened, but they're obviously under immense amounts of pressure. So for retailers, it depends very much on your product range. The sector's in turmoil, but it is starting to loosen now. And there's really a number of impacts that come through, right from the turnover line, GP percentage under pressure for the reasons that we explained. You're having to basically just get rid of product to get cash, and operating margins will certainly be under pressure. The key theme that we talk about in our analyst meetings back at Anchor is what will the run rate be in 12 months' time? And as long as your balance sheet hasn't been destroyed along the way, that's probably a fair way to try and value a business. So we think in 6 months' time, sales will probably be down about 10% in aggregate from where they were, say, in December, January this year, before the COVID disaster. Quite a jarring number is April new vehicle sales in South Africa. The whole of South Africa was 574. And that averages kind of 35 to 40,000 going back to normal times. Brian Joffe told us a little bit about Sportsman's Warehouse. They can sell about 50% of their products at the moment at level 4. And the products that they are allowed to sell, they're in fact selling higher volumes than they were a year ago. A company like Fushini in the eye of the storm, with a lot of debt on their balance sheet. And there, to put in context, last year's profit before tax was about 3.6 billion. And each month, with normal sales, they generates around 1.5 billion rand of gross profit. So 3 or 4 months of level 3 could effectively put them into big losses for the year. And obviously, there also the concern about the debtors book and people repaying their debts. Pick n Pay told us that they still can't sell about 20% of their product. And a lot of that product is at higher margin. So in fact, at the extreme, Pick n Pay probably making a monthly loss in the month of April. SPAR is kind of a standout for us. We've got, I think there you've got the theme in SPAR of largely a franchisee business. And Pick n Pay also said their franchisees tend to outperform. So entrepreneurs who are reacting quickly, getting the right product in, selling stuff at the right price are tending to outperform. So we quite like SPAR from that perspective. And then Spur, 155 open, and they've cut their salaries across the board. Some interesting stuff from Pick n Pay. This is what customers stockpiled on before the crisis. Quite bizarre that bleach coming in third, 138% growth. Perhaps people were believing what Donald Trump had to say. Vodka at number 4 and toilet paper at number 5. During the lockdown, 288% growth in paints and brushes, and then a lot of the stuff that's required to home cook, not surprisingly. And this shows kind of lemming behavior out there in the public. The days that have seen the biggest increase in spend have in fact been Tuesdays. So everybody thinks cleverly that nobody shops on a Tuesday, so everybody's gone to shop on a Tuesday. And the biggest drop in weekend sales. And shoppers are visiting stores less, but spending more per visit. And then a huge increase, 200% increase in active transacting customers online in the Pick n Pay world. Then lastly, to look at the customers. So this is quite a nice simple graph, and we talked about accelerating trends where there was a continual increase. This is the percentage of e-commerce as a percentage of retail sales in America. And you can see the trend growing every year by 1 or 2%. And then suddenly in an 8-week period, accelerating dramatically. Another very interesting and key piece of information, we've just got through the Chinese retail sales. And the month of April, which is getting back to normalization, sales are down 8% year on year. And that's part of what informs our estimate of sales in South Africa in 6 months' time being down about 10% year on year. So that's a trip around corporate South Africa. I've had some calls with mates who, people have been isolated and they don't know what's happening to other businesses out there. There's a lot of people taking a lot of pain, with the kind of key message being that Brian Joffe message. Prepare for the worst, but hope for the best. So to summarize the message that we're sending, our key imperative and what informs everything is we want to buy great businesses at great prices. South African company profits down more than 50, dividends down more than 70, 12 to 36 months to reach normality, and the underlying consumer trends will accelerate even more. So corporate South Africa is reacting quickly, and we out there trying to find opportunities to take advantage from an investment point of view to make this an opportunity set and one that we come out stronger.